Okay, so up until now, we've taken an in-depth look into the smart money cycle, both on the weekly and the intraday charts. We've also taken a look at the two eventualities that could happen once a cycle has completed. So once we've seen three levels of rise or fall, we know that we're going to have a midweek reversal or we're going to see a trend continuation. Now, throughout the course, we've spoken a lot about manipulation levels and areas of deep liquidity where smart money will be incentivized to push prices to execute their trades. In this next section, we're going to take a look at the variety of tools and technical levels that we use to identify these levels that ultimately allow us to trade in line with the smart money cycle. Okay, so by now we understand that once smart money have accumulated a position, the next step in the process is to manipulate retail traders into the wrong side of the market, and they do this by running prices into an area where pending orders and breakout orders will generally enter the market, and these will occur in places of prior support and resistance. Now, the most common areas that retail traders will place pending orders and look for breakout and support and resistance trading opportunities are horizontal support and resistance levels, trend lines, session highs and lows, daily highs and lows, previous days highs and lows, pivot points, whole numbers, Fibonacci internal and external retracements, and also moving averages. So each one of these areas or technical levels all act as support and resistance zones. Okay, so 9 out of 10 traders will generally have 2 or 3 of these levels marked out on their charts, and in doing so will generally place stop losses or look for breakouts of these areas or levels, and smart money will keep an eye in and around these price zones and look for a build up of orders. Now, what's important to understand is when 2 or 3 of these levels fall together in a relatively narrow price range, deep pools of liquidity may build up around that price point. And this is because when there is a confluence of different support and resistance zones, the buy and sell orders of retail traders from a wide variety of trading strategies and also schools of thought are drawn to this specific area. So, for example, if we have a trader who primarily trades horizontal support and resistance zones, and we have a Fibonacci trader, and on any one chart we have the 50% internal retracement fall very closely to a horizontal support and resistance zone, such as the high of the Japanese range, for example, then we're going to have a build-up of orders from 2 different types of traders from 2 different schools of thought. And many times you will see 2, 3 or even 4 different levels fall together within a relatively narrow price range, and by its very nature this act causes a deep pool of liquidity, and smart money will very often be incentivized to push prices into these regions to execute their trades. So before we go on and look at the individual levels, it's very important to remember that all manipulation levels should be in context with the smart money trend. Okay, identifying individual support and resistance zones or even a confluence of support and resistance zones does not mean anything if it's not in line with the smart money trend. Okay, so for example, if we've identified a phase 1 coming out of level 3 accumulation, the following day we're going to be looking for manipulation levels of buy orders that smart money are going to sell into to continue phase 2 of the trend. So every time we're looking for levels of deep liquidity, We're going to be able to find this on all markets and also all time frames. But if they are not in line with the identified weekly cycle, then the areas of liquidity mean nothing. Okay, so very important, guys. Always look for manipulation levels in line with the smart money trend. The only time, as we learned in our previous section, that we're going to trade both sides of a level is when there is no cycle and we're in level 3 accumulation. Okay, so always have the identified trend cycle in mind when looking for areas of manipulation. Now, in regards to the time frames that we use to identify our levels, the 15-minute time frame is where we identify high probability manipulation areas intraday for the next phase in the smart money cycle. And we've seen examples of this previous, where once we've identified the longer term weekly cycle on the hourly chart, we would then drop down to the 15-minute time frame to identify areas of deep liquidity where smart money may choose to manipulate orders. Now, the hourly time frame is the primary time frame to identify the smart money longer term daily trend. And we saw in the last section that we identify the weekly cycle by using the 1 hour time frame. Now, this time frame can also be used to identify higher degrees of support and resistance that may overlap or confirm those identified on the 15-minute chart. Okay, and you'll generally find the higher the time frame you go and the higher the support and resistance levels are identified, the deeper the pools of liquidity. Okay, so not only will we mark off the intraday support and resistance levels that are in line with the smart money trend, but we will also mark off significant levels that we find on the 1 hourly and also the daily time frame. Now, when we have a overlap or the levels from different time frames fall together within a relatively narrow price range, these make for some of the deepest pools of liquidity in all of trading. So we'll take a look at the overlapping of support and resistance levels on different time frames. So a good example are Fibonacci internal retracements and also horizontal support and resistance levels plotted from higher time frames. So we previously discussed the Fibonacci and horizontal levels falling together on a intraday level, but if we have a horizontal support and resistance identified on the 15-minute chart, and this was to say overlap with a Fibonacci retracement from the 1 hour chart, this will make again for a very deep pool of liquidity. Okay, so we're now on to our first manipulation zone, and in my opinion probably the most powerful, and these are horizontal support and resistance zones. Okay, so horizontal levels are the most powerful types of support and resistance, as they are fixed levels where smart money can accumulate and absorb orders. So in the examples where we saw the accumulation period throughout the Japanese session or in level 3 accumulation, we saw that these zones formed horizontal support and resistance zones both to the up and to the downside, and these levels are fixed. Now, why is that important? Well, when we have fixed support and resistance zones, it means that more traders are likely to see it. Okay, with the more dynamic zones such as Fibonacci, internal and external retracements, which we will look at a bit later, these can move around depending on new highs or new swing highs and swing lows coming into a trend or a market. So horizontal zones tend to stay fixed, and this is very important again because pending orders and breakout opportunities will present themselves at these levels. So horizontal levels and trend lines are the most widely taught form of support and resistance. yet their importance and purpose is often overlooked or misunderstood by the majority of traders. And this goes back to the trading of effect as opposed to cause, and also the hows and the whats of technical analysis against the whys. So because the majority of retail traders aren't really taught the real cause and also the institutional interest in and around these levels, they will tend to dismiss them as being mere lines on a chart that they should watch. So horizontal trend lines are obvious and stand out to even the most inexperienced of traders, and you've looked in the first part of this course at how to identify and plot these levels. So this means that a vast majority of retail traders will gravitate towards specific levels on a price chart and place buy and sell orders in and around these areas. Okay, so because the identification and also the plotting of horizontal trend lines is very simple and very obvious, it simply means that a vast majority of retail traders will be looking at the same price points. Okay, and smart money are aware of this. So deep pools of liquidity that smart money require to execute their orders will develop. Okay, so how do we utilize horizontal support and resistance zones on a day-to-day basis to allow us to trade in line with the smart money cycle? Well, when looking for areas of potential manipulation on the current trading day, we look at the 15-minute chart and we start by marking off the horizontal support or resistance levels set during the Asian range. So we've looked at previous examples of the accumulation zone which takes place during the Asian range, and we saw that this typically sets a very tight support and resistance zone. Okay, so the levels we're going to mark off must be in line with the present smart money trend. So all that means, if for example we have recognized phase 1 coming out of level 3 accumulation to the upside, and we're expecting our second phase on the current trading day, we're going to be looking for the manipulation of sell orders. Okay, because we know if we have a second level or second rise to the upside, then smart money are going to induce traders to sell so they can buy into this selling pressure and unfold the second part of the weekly cycle. So during the Asian session, we would look to mark off the area of support, as we know that during the London session, if the area of support is broken, this will induce sellers into the market and allow smart money to achieve their aim. So we're always going to be looking to mark off the support or resistance level which is in line with the present smart money trend. So on the flip side, if we had identified a bearish phase 1 or phase 2 on our 60-minute time frame, on the current day's trading on the 15-minute chart, the first horizontal support and resistance level we're going to mark out would be the resistance zone of the Japanese range. Because if we've identified a bearish cycle, whether this be phase 1 or phase 2, we know that in the following day's trading there's going to be manipulation and the induction of traders to the buy side, and then smart money will sell into this buying pressure and unfold the next part of the weekly cycle. So in this case, where we have identified a phase 1 coming out of level 3 accumulation, the following day on our 15-minute chart we're going to mark off the resistance zone of the Asian range, and this will put us in line with the overall cycle, because as we know, if we see a break of this resistance area, we will get the breakout traders which will enter into the market, Also, anybody that's sold during the accumulation period will generally have their stop loss just above the high of the session, which is the resistance zone. And once the smart money pushes prices above this resistance area, they will be able to sell into the buying pressure of retail traders. So very simple, very straightforward. In terms of the horizontal support and resistance lines, we're going to identify the cycle, and then we're going to mark off the relevant horizontal support or resistance zones which are in line with the overall weekly cycle. So once we've marked off and identified our first horizontal support and resistance level for the current day's trading, how do we identify any others? Well, we simply mark off the recent and obvious support or resistance levels which are above or below the Asian range. And then we're going to look at previous price action at these new identified levels, and we're also going to check to see if manipulation has previously taken place. So in our previous example, we had identified a bearish phase 1 coming out of level 3 accumulation. We had identified on the current day's trading the resistance area for the Asian range. But if smart money push prices through this resistance area, but there isn't enough volume for them to execute their orders, where else may they choose to manipulate? And this is the thought process that should be going through your head when you're looking to identify these levels. Now, with horizontal support and resistance levels, they should be kept as obvious as possible, because the more obvious and the more simple that they are, the more chance that more retail traders are aware of them. Okay, so in terms of the easily identifiable levels, we have another level of resistance here. We also have the previous day's Japanese session, and then we also have another significant support and resistance zone just above there at the peak. So if we take a look at previous price action at these levels, we have 1, 2, 3 touches of our first horizontal zone. Our second, we have 1, 2, 3. And with our higher manipulation level, we'll have to scroll back to take a look at prior price action. And we can see that not only does it have a previous touch, but also that it was used as the manipulation of the Asian session of 2 days prior. So if I scroll back to the current day, we have identified 4 potential levels where manipulation of retail orders could take place, and we'll be looking for price action to come into one of these levels, identify the candle formation of manipulation, whether this be a reversal candlestick formation or the process that you will learn later on in the section, and then this will allow us to trade in line with smart money. So very simple and very straightforward. We're simply marking off the Asian range, which is in line with the weekly cycle, and then we're going to identify the simple and significant swing highs and swing lows to mark off further areas where smart money may choose to manipulate the market. And if we move the market on, we can see that the Asian range has been broken, and we'll be looking for evidence of manipulation. We can see that we have a reversal candlestick pattern here, Okay, so as you can see, our first identified level was broken. The market turned and then came back up, creating that M formation. But it was our second identified level where the manipulation ultimately took place. Okay, and this is why it is essential that we identify as many areas as possible which meet the criteria where smart money may choose to absorb retail orders. So in this example, if I just zoom in there, we can clearly see that smart money aggressively drove prices up with all these green bars into our second identified zone. At one point this bar would have all been green, but as smart money began to sell into this buying pressure, they ultimately pushed the market down, and then the second phase of the weekly cycle unfolded. Okay, so in this second example, we've identified a bullish phase one. So on our current day's trading, we're going to be looking for manipulation of sell orders that smart money can buy into and unfold the second part of the bull trend. So first thing we're going to do is we're going to mark off the Japanese session lows, and then we're simply going to look for other obvious levels of support and resistance where most retail traders will have marked off on their chart. So straight away we can see that we have the previous day's Asian range, and we can see that we have a touch to the upside, and then as the market comes up we can see that it acts as a level of support. Now the important thing is to always look back and just check that the levels in which you're identifying have previously acted as a level of support and resistance, and we can see evidence of this multiple times on both sides of the line. So we can see here it acted as a level of resistance, here is support, you can see a touch here, and also the previous two that we pointed out. The more touches, the more obvious the level, and the more retail traders that will likely have the level on their charts. Now the next obvious level will be the low of the previous day's Japanese session, and again you want to look back and just take a look at previous price action in and around this level. So we can see that during the US session it was used as a manipulation level. We can also see numerous touches as it acted as a level of support. Here we can see a level of resistance. So we have 3 identified levels, and then we can also use the very last one right at the bottom. Again, we're going to look back and just see if there is any previous action in and around this level, and we can see that it acted as a level of resistance here. Again, a level of resistance, a level of resistance. So we can see that the 4 levels that we have pointed out have all previously acted as a level of support or resistance. So in terms of the current day's trading, and I'm just going to zoom in here so we can see the chart more clearly, we're simply going to be looking for manipulation of one of these levels during the London session. So if I move the chart on, we can see that we have broken the low of the Japanese session for the current day's trading, and then the market moves off to the upside. So in this example, where smart money broke the support zone of the Japanese session lows, there was enough volume both accumulated and absorbed at this level that smart money were able to fulfill their orders and continue with the second phase of the weekly cycle. So the most important thing with horizontal support and resistance zones is to keep it as simple as possible. Now, one thing I do want to quickly cover is, in this example, we have the lows of the Japanese session, but just below the level we have a level of support here. And if we were to scroll back, we can see that this also acted as a level of support and resistance. So what do we do in situations like this, where we have two levels which fall within a relatively narrow price range to each other? But in this case, they're not different types of technical tools. It's the same thing. Well, depending on the market, generally you will go for the horizontal zone which is furthest. Okay, so the rule of thumb we use here at Trade Simple, Trade Smart is if you have two horizontal zones which are within 10 points of each other, then you're going to go for the furthest. And this is simply because where the two zones are so close to each other, 9 times out of 10 smart money are going to go for the deepest zone, because that way they can absorb orders from both of the identified areas. Now, there are exceptions to this rule. For example, in the two lower identified areas, we have a zone at 102.26.2, and we also have a zone at 102.18.3. So we have a difference of around 8 points. So in general, we would simply delete the first one, and we'll be looking for manipulation of our level at 102.18. Now, what would change our minds in terms of going with the highest at 102.26 as opposed to 102.18? Well, what would reinforce and give us more incentive to go with the first level is if it aligned with another technical level. Okay, so in this example, if the level at 102.26 aligned with a Fibonacci ratio or a pivot point or something of that nature, and we had no overlaps of other technical levels at the lower, then we would be more inclined to go with the highest identified level. So keep in mind the 10-point rule. If they fall within 10 points of each other, we would generally go for the furthest. But in cases where the closer identified level overlaps with other technical levels, we're going to leave this and look for manipulation in and around the level. Okay, so when you're identifying horizontal support and resistance zones, the most important thing is to keep it simple. So the 4 questions you want to ask yourself is, does this qualify as a support and resistance level? Has price shown both support and resistance at this level? Is there evidence of prior manipulation? And does this level fall close to other support and resistance zones? Now, if you ask yourself these 4 questions, then the levels that you identify should qualify as a potential manipulation zone. And as we covered in the last example, if 2 horizontal levels are identified within 10 points of each other, it is safer to use the highest or lowest identified level. This is because smart money is more likely to spend the extra bit of cash to push the market's price to the zone to initiate a stop run. Okay, now another exception to this rule is where the ADR on a currency pair is narrow. Okay, so if you have a currency pair where the daily range is very small or very narrow in comparison to others, then you might want to leave both of the manipulation zones on the charts, even if they fall within the 10-point range. So when horizontal support and resistance levels fall within a relatively narrow price range to other support and resistance levels, such as pivot points or moving averages, then more retail traders will be watching this level. And this simply goes back to the different schools of thought and the different technical tools that retail traders use to analyze the financial markets. If we have a confluence of different technical levels falling within a relatively narrow price range, then the result of this is more retail traders will be placing pending orders in and around the level and also looking for breakout opportunities. Now, levels which are very close or overlap with higher time frame support and resistance, such as the 4-hour and the daily time frames, should be paid close attention to. So get into the habit of, when you're analyzing a currency pair, that you mark off the higher time frame support and resistance zones. What we tend to do here at Trade Simple Trade Smart is we will use say a red horizontal line for the daily, and we may use a green for the 4-hour, and on MT4 they will all show up on whatever time frame you are looking at. So on the current day's trading, if you've identified your levels for the day and they fall within a relatively narrow price range to the identified levels on the higher time frames, these areas should be paid special attention to, because smart money will also be aware of the orders building up around these areas. Now, a common question when identifying horizontal support and resistance levels is, do I use the candle body or the candle wicks to identify these zones? So when using candlesticks to identify horizontal support and resistance levels, the bodies of the candles should be used. Okay, and in the examples that we went over, I would typically use the body of the identified level to mark off the horizontal zone. Now, the exception to this rule is when the area identified has candlesticks with several extreme wicks. So many times when you're looking at a swing high or a swing low, sometimes the candles that make up the swings will have extreme candlestick wicks. Now, if you see 2 or 3 of these fall within a very close range to each other in terms of the high, the low, then you may want to go with the wick. So when this occurs, to reinforce your decision, check and compare whether the bodies or the wicks of the candles fall more in line with previous support or resistance in the area. Okay, so again, just keep it simple. If you're unsure, mark off the body of the swing high or the swing low and also the wick, and then just look back at previous price action and look at which of the 2 identified level falls more in line with previous support and resistance, and you're better to go with the horizontal zone that has shown prior action at the level. In this next section on identify manipulation levels, we're going to take a look at the current day high and lows. So the high and the low of the day is where smart money induce traders into bad trades and trap volume for the present or following trading session. And we've seen evidence of this throughout the course, where we've looked at the manipulation of both the highs and also the lows of the Japanese session, which very often will be the high or low of the day. Now, in terms of trapping traders for the following day's trading session, this manipulation will generally happen during the New York reversal, where smart money will generally set the high or the low of the day and then quickly reverse back into the range of the day's trend, trapping traders for the following session's manipulation. Now, the high and low of the day is usually in line with a prior support or resistance level. Okay, so very often when the high or the low of the day is set for your current day's trading session, if you were to look back into the past, you would generally see that it will align with a prior level of support and resistance. And this is where the intraday M or W formation and candles with long wicks will be most commonly seen. And this occurs because smart money is triggering and absorbing retail orders. So once we see the manipulation occur, we know it can take the form of candlestick formations or more obvious formations such as the M or the W. So when you do see the M or W formation, it's very often a telltale sign that the high or the low of the day has been set. And as we know, they're generally used to induce traders into the wrong side of the market so smart money can absorb the orders and then unfold the trend. So once these levels have been established, smart money will absorb and hit the stops of retail orders on both sides of the market. This action accumulates orders at a better aggregate price as well as shake out those traders on both sides of the market. So when we look at the M and W formation in terms of a stop run, you will learn that the traders on both sides of a market are shaken out. So for example, if we're in a bear trend, what will happen is they will induce traders to buy. They will then sell into this buying pressure, and then if they throw in the M or W formation, what they're generally doing is those traders who weren't manipulated or induced into the wrong side of the market and have managed to align themselves with the smart money trend, smart money will then make another pass at the high or the low, which creates the M or W, and this shakes out the traders on both sides of the market. So once the required volume has been accumulated, they will quickly shift off the low of the day and the high of the day in one bar, leaving the remaining traders trapped. And the manipulation of the Asian session daily high and low is an example of how this level is manipulated. In this first example, we're looking at the US dollar versus the Canadian dollar, and I've marked both the daily high and also the daily low. Now, in terms of the price behavior that smart money will exhibit around these levels, we're generally going to see one of two things. We're going to see a candlestick manipulation formation, or we're going to see the characteristic M or W. Now, they're both used for two purposes. One is to induce traders into the wrong side of the market, and the second is to trap volume. So if we look at the daily session for this day in question, we can see that we have the accumulation during the Asian session, and we can see from the price action that the high of the day also takes place during the Japanese session. Now, look at the price behavior which takes place around the high. We see the M formation. Okay, so the M formation, which is a classic characteristic of both the high and also the W in terms of the low of the day, takes place at the high of the day. And this is simply to induce traders into the wrong side of the market. So we have a break of the session highs, inducing traders into the wrong side of the market. Smart money then pushed the market down. Now, this is where the M and W formation come into play, because those traders who bought on the breakout of the resistance zone will have their set buying pressure sold into, and this will cause the market to come down. Now, those traders who begin to sell during this push to the downside are in line with the smart money trend. So many of them will place their stop just above the resistance zone. So smart money will push prices back up, stop them out or shake them out, and then continue with the trend. Now the same behavior takes place at the low of the day. Okay, so at the low of the day, we're generally going to see a candlestick formation, which will represent manipulation, or we're going to see the classic W formation. And the same process in terms of this shakeout with the W formation occurs as with the M formation. So in our example, we saw that the downtrend continued, and then we see this spike to the low side. And if we look back, we will see that this level of support will coincide with prior levels of support and resistance, so therefore will be marked out on retail traders charts. They induce traders into the sell side, and this green bar here, which is quite aggressive, we can see that smart money buy into the selling pressure. Once this happens, the market comes back down, and then we see the classic W formation. So again, the same thing occurs. Those traders who did not get induced into the sell side of the market, but bought during the aggressive move to the upside, where smart money started to buy into the market, these traders are now in line with the new market trend. So smart money need to shake these guys out of the market, and they do this by throwing the W formation. And because most of the traders that bought in and around these levels will have their stop below the support zone, smart money throw the pin just beyond this level, stop them out, and then continue with the new trend to the upside, and in this case represents the New York reversal. So the high and low of the day, you will typically see an M or W formation, and we're going to scroll back and just take a look to see if these levels align with previous support and resistance. And we can see in terms of the high of the day, we can see that it acts as a resistance here. We can see prior manipulation take place, and you can see many points where the level has been tested. We can go further out. Again, the high, this is some 3 days later, we can see more tests of the high. Again, so the high of the session was a very strong prior support and resistance level, and if we take a look at the lows of the day, we can see that this also was a strong level of support and resistance. We have the level acting as a level of support in 3 different occasions. So again, with both the high and lows of the day, we're generally going to see manipulation take place, whether this is to induce traders into the wrong side of the market or to trap traders for the following day's session, and they will generally align with prior support and resistance levels. In the second example, we're looking at the sterling against the dollar, and again we're looking at both the high and low of the current day's session. Now in this example, we can see the accumulation process take place during Japan, and then we see the high of the day set during the London session. Now just notice the price behavior that takes place as the high is being set. We see the classic M formation. Okay, and again, this is typical of the price behavior set at the high of the day. Now, something you will generally notice is you will have an aggressive move from either the high or the low of the day once traders have been induced into the wrong side of the market, and this is done to trap traders who have entered the wrong side. So if you can imagine that you've seen the break of our resistance level and you've bought into the market, this bar is where you start to get knots in your stomach. Okay, because if we measure the range from the high down to the two red bars, we can see a range of 25 pips. Now, most retail traders are taught to place their stop generally around 20 to 25 points from entry. So if you had bought on the break of the resistance zone, more than likely you're going to be stopped out. Now, for those traders who have larger accounts and can afford to have a wider stop, say 50, what happens to them? Well, they're trapped at the high of the day. Now, unless you have a good understanding of cycle and you understand how smart money move the market, generally most of these traders are going to have their fingers crossed that the market's going to return to their level. But we know that, for example, if this was phase one, that we know there's going to be another 2 cycles to the downside. So inevitably, whether you have a 50-point stop or a 100-point stop, you're going to be stopped out. Okay, so if we measure the range from the high down to the low of the day, we have a 81 pip range. Okay, so most retail traders will not have an 80 pip stop. So more than likely, most of the traders who are induced or trapped at this level will be stopped out. Now, as the aggressive bar moves to the downside and the trend unfolds, we get to the low of the day and we're in the New York session. And during the New York session, we know that smart money will generally liquidate the majority of their position, and to do so they will need to induce the opposite side of the market in. So during the accumulation process, we know that the market dropped, so they were accumulating sell orders during the accumulation process. So come the New York session and the low of the day, if they want to liquidate the majority of the position, they have to induce sellers into the market so they can buy into this selling pressure, therefore liquidating their position. So as the low of the day comes, again, it will not always be a W formation. Okay, and just like with the highs of the day, we're not always going to see the M formation. Sometimes we're going to see candlestick formations such as reversal legs or any kind of reversal formation. In this case, we can see that we have 4 wicks to the low. Okay, so this prior level of support and resistance, each time smart money break it, notice that it never closes below the level. Okay, so smart money, each time they break the level, they buy back into this selling pressure, and then the New York reversal unfolds as smart money liquidate their position, and the reversal enters back into the range of the prior trend. And again, one thing to notice is just prior to the reversal back into the range, that smart money aggressively move off the low of the day with this aggressive bar to the upside, and this traps traders at the low of the day. So once the day's high and low have been set for the current day's trading session and the market returns into accumulation and we begin the new day, what happens to the prior day's high and day low? Well, these levels act as natural support and resistance areas, and many traders, both institutional and also retail, will mark these levels off on their chart. So again, this presents the opportunity for retail orders to build up in and around these levels, and the induction of traders into the wrong side of the market if smart money are to penetrate one of these levels. Okay, so the previous day high and low is a strong daily support and resistance level which will be often tested and rejected. Smart money know that both trap volume from the previous day and breakout traders pending orders are stacked up around this level. So the previous day's high and low act the exact same way as horizontal support and resistance levels. The only difference being is that they're dynamic in that they change every day. So smart money will generally not want to release the trap volume from the previous day. So they will push the current day's high or low generally in spikes close enough to the level to hit stops and induce traders in the wrong direction. So during the New York reversal, which will typically be the high or the low of the day, we have traders that have bought in just before the reversal back into the range, and these traders are trapped. And because they're trapped, this allows smart money to re-enter the accumulation phase, and then they can stop these traders out of the market. But what they will generally do is, because they know that breakout traders will be looking in and around these levels for opportunities to enter, smart money will many times come very close to the previous day high and low, penetrate the level, induce breakout traders into the wrong side of the market, and then sell or buy into this pressure. Now, they will not penetrate the level high or low enough to release the trap volume from the previous day. And this may sound a little confusing, but we're going to take a look at a couple of chart examples, and we're going to look at the previous day's high and low zone. In this first example, we're looking at the sterling against the dollar, and we're looking at a typical intraday session. So we have the accumulation taking place during the Japanese session. We then have our move against their intended direction. We then have the unfolding of the trend, and then we have the New York reversal at the end of the day. So a typical trading session. Now, in terms of the high and low set for the day, we have the high set during the London session, which is the high of the stop run, and then we have the low, which is set during the US session, and this turns and creates the New York reversal. So the high of the day set during the London session, and the low of the day set during the US session. Now, in terms of the trap volume, those traders who typically get in at the last stages of a trend will generally get in and around the US session. Now, what happens here is, when the New York reversal unfolds, any trader who sold in and around this bar become trapped. Okay, so if you can imagine you're a retail trader and you've seen the market come all the way down, and then you decide to sell into a time where smart money are going to be liquidating the majority of their position, and you sell in and around this bar, the reversal during the US session is 26 pips. Okay, now, as I've stated before, most retail traders are generally taught to place their stop 20 to 25 pips from entry. Okay, so those traders who got in at the worst possible point during the US session would generally be stopped out 25 pips later. Now, those traders who have a larger stop they will generally be taken out during the London Open of the next day. Okay, and we will take a look at how that works. But for now, we're looking at the high and also the low set for the session. So if we move on to day 2, and I've marked out the low of the day from the previous session, and look what happens. During the Asian session, we see a test and rejection of the previous day's low. Okay, so the market makers are aware that retail traders will have the previous day's high and low marked out on their chart. They know that they'll be looking for breakout opportunities, so they throw the pin just below the area and then they pull the market back. And if we take a look at how far they pull it back, again we can see it's 31.5 pips. So the same process is happening. We have traders who would have sold on the break of the session of the previous day's low. Smart money quickly snap the price back by 30 pips and stop those traders out. Now, if we take a look at the volume which was trapped the previous day, those traders who may have had a larger stop and survived the pullback of 25 pips during the previous day's session, they will still be in the market. Now, this trap volume, once we get the stop run of the Asian session, we can see they pull it back by another 5 pips. Okay, so those traders who are trapped will generally be stopped out. If not during the US session, they will be caught during the Asian session or the open of the London session the following day. So in terms of the previous day's low, we can see again the test and rejection, a pullback, a stop run of the Asian highs, and then we can see the unfolding of the trend. So if I delete the high and low from the day 1 and we mark the high and low for the second day session, and we move on to day 3. So on the third day, again we have the same intraday process that we're now very familiar with. Accumulation, we have the stop run, and we have the unfolding of the trend. Now in terms of the previous day's low, we can see that we have an aggressive pin to the downside, which is quickly snapped back, which is used to induce traders again into the wrong side of the market. And then we can see a set of reversal candles here, and then an ultimate reversal back into the range. So again on day 3, which is phase 3 in this bearish cycle, we can see a test and a rejection of the previous day's lows, and then a move back into the range. I do the same thing, and we mark off the high and also the low of the session, and we'll move on to day 4. Okay, and in day 4 we have no action of the previous day's lows, but look at what they do at the previous day's highs. Again, we have that test and rejection, inducing traders into the wrong side of the market, absorbing pending orders, and then a move against their intended direction. So in terms of the highs and lows of the day, and also the previous day's highs and lows, we're always going to have them marked off on our charts, because they are zones that institutional and retail traders are aware of, and they are places where orders will tend to build up in terms of stop loss and pending orders. Breakout opportunities are also looked for in and around these areas, allowing smart money to induce traders into the wrong side of the market, sell or buy into this pressure, and then unfold or unload their orders.